What's going on, folks? Welcome to the Trade Well podcast, brought to you by Trade Well Management. I am your host, Donovan Marquez, the podcast where we discuss everything trading these financial markets, as well as acting as a personal trading journey and road to profitability. Thank you for tuning in, and I hope you enjoy the show. What's going on, everyone? Welcome back to the Trade Well podcast. I'm Donovan Marquez, and today we're talking about something that every trader, especially beginners, needs to understand inside and out, and that is risk management. Now, I know risk management doesn't sound sexy as spotting a hot trade or a big profits, but let me tell you this. Without solid risk management, you won't be in the game for long. If there's one thing that separates successful traders from the rest, it's knowing how to protect your capital and managing risk like a pro. By the end of this episode, you'll know how to make sure you never risk too much on a single trade, how to set yourself up to survive the losing streaks, and how to keep your trading account safe so you can trade another day. Let's get into it, guys. So let's kick things off with the obvious question. Why is risk management such a big deal? Here's the thing. Trading is risky. You're not going to win every trade, and that's completely normal. But if you don't manage your risk, just a few bad trades can wipe out your entire account. That's why protecting your capital is rule number one in day trading. Think about it like this. You can't make money if you don't have money to trade with, right? Risk management is all about keeping your losses small enough so you can stay in the game long term. Trust me. Trading is a marathon, not a sprint. I don't care what you see on social media. I don't care what these gurus tell you about making 1,000% in a week. It's not going to happen long term. Let me go ahead and give you a quick little rule. That is the 1% rule. The first risk management tip you should live by is the 1% rule. This is a simple but powerful rule. Never risk more than 1% of your total trading account on a single trade. So let's break this down in simple terms. If you have $10,000 in your trading account, you should never risk more than $100 on any trade. Even if you lose, it's just 1% of your total capital, which means you can still come back and trade another day. That's the important here. That's what's key in here. So the key here is to keep your risk small and manageable. A lot of beginners make the mistakes of putting too much money on the line, thinking, well, if I just make one big trade, I'll make a lot of money fast. Yeah, but that's how accounts blow up. If you risk 10, 20, or even more on a single trade, it doesn't take long before your account is drained after a few losses. It's that simple, guys. Stick to the 1% rule and you'll protect your account from taking big hits. So we're going to go back over this again, just so we make it clear. We're going to talk about stop losses, which we've mentioned in previous episodes, but I have to keep going on this. Stop loss orders are one of the best tools for managing risk because they limit how much you can lose on any given trade. A stop loss order is just set up automatically to sell your position if the price drops a certain level. This prevents your losses from getting out of hand. Let's say you buy a stock XYZ at 100 and you set your stop loss at $95. If the price drops to $95, your platform will automatically sell it, locking in $5 loss per share. You don't have to sit there and watch your trade spiral into disaster and blow your account to oblivion, okay? So how do you decide where to set your stop loss? There are several different ways of doing this, but let me go ahead and just give you a quick tip. Look at how much you're willing to lose based on the 1% rule, place your stop loss accordingly. So let's give you a quick example for, we'll do stock XYZ again. Okay. So for example, you have $10,000 and you only want to risk $100. Figure out how many shares of stock XYZ that you can buy and where to place your stop loss so that your maximum total loss is $100. This keeps your losses under control, even if the trade doesn't go your way. Okay. Now we'll go ahead and go over position sizing and how much should you trade with in a single position. So now that we've talked about the 1% rule and stop losses, let's dive into another key concept in risk management, and that is position sizing. Or in other words, how much of a stock or asset you could actually buy or sell in a trade. This ties directly into the 1% rule and stop losses. Your position size depends on how much you're willing to risk where you place your stop loss. So let's go ahead and get another quick example. We'll stick with 10K for all these examples. So let's say you have $10,000 in an account and you're willing to risk 1%. That's $100. If you decide to place your stop loss $2 below your entry price, so you divide $100, the amount of risk you're willing to trade, by $2, the difference between your entry price and stop loss, this gives you about 50 shares to trade. So this formula is position size basically equals amount to risk, entry price plus stop loss price. Okay. So by using this formula, you can make sure you're always trading the right amount and not risking more than you're comfortable with. Another thing a lot of traders like to go over is risk to reward ratio to see if the trade is worth it, or a lot of, if whatever you're seeing on social media or YouTube, whatever, you'll see it's called R&R. People talk R&R all the time. So another important part of risk management is understanding the risk to reward ratio. This is basically asking yourself, is the potential reward of this trade worth the risk I'm about to take? So here's how it works. Let's say you're risking that $100 on a trade using the 1% rule. Now you need to figure out how much you stand to gain. If you're only aiming to make $50, that's an R&R of 2-to-1. You're risking $100 to make 50, which isn't a great deal. Okay. You understand that if from business aspects, if I give you $100 and you only give me back 50, then I'm not getting much of a good deal there. You know what I mean? On the other hand, if you're aiming to make $300, you've got a risk to reward of 1-to-3, which is much better because you're risking $100 to potentially make $300, if you get that concept. A good rule of thumb is to aim for a risk to reward ratio of at least 1-to-2 or better. So that means for every dollar you risk, you're aiming to make $2 or more. This way, even if you have some losing trades, your winners will more than likely make up for the losing trades. Another big thing that a lot of these traders out here don't like to talk about is surviving a losing streak. You will have them. They are inevitable. Get used to that fact. So let's be real, guys. Losing streaks happen to everyone. Even the best traders in the world have bad days or even weeks. The key is how you handle those losing streaks, though. So first, remember that losing is a part of the game. No strategy will give you 100% winners, and that is okay. The goal isn't to avoid losses altogether. It's to make sure your losses are small enough that you don't wipe out your whole account. This is why the 1% rule and proper position sizing is so important. If you stick to them, even in a string of losses, you won't destroy your account completely. You might lose a few trades in a row, but your account will still be in good shape to trade again. That's the main thing. The worst thing you can do during a losing streak is what's called revenge trading. We are all guilty of this. That's when you try to make back your losses by taking bigger risk, hoping to get lucky. More often than not, revenge trading just leads to more losses, and instead, you take a step back and review your strategy and get back to the basics, guys. That's what it's all about. But that pretty much wraps up today's episode on risk management. If you take away one thing from this episode, guys, let it be this. Protecting your capital is the key to surviving and thriving as a day trader. By following the 1% rule, using your stop losses, and managing your position size, you'll put yourself in a position to weather the inevitable ups and downs of the markets. Okay? In the next episode, we're going to dive into back testing a little more. And that's how to test your strategies on historical data to see if they hold up before you put real money on the line. Trust me, guys, you don't want to miss it. But of course, if you found today's episode helpful, make sure to subscribe and leave me a review. And share this podcast with anyone who's learning to trade. Yourself, your friends, your grandma, your uncles, I don't care. Share this podcast with them if you found this information helpful. And as always, feel free to reach out anytime on social media if you have any questions or thoughts. All right? So with that being said, guys, stay sharp, stay steady, and trade well. We'll see y'all on the next one. That's all we have for you today, folks. Thank you for tuning in. I hope you were able to gather some information and value from this episode to apply into your own trading journey. Don't forget to give us a rating and review anywhere that this podcast is hosted. Also, please don't forget to like and subscribe to our YouTube channel at TradeWell Management, where we upload our daily trade videos and a full time-lapse, unedited raw time-lapse of our daily trades so y'all can see what real day trading looks like. Thank you for tuning in. I hope y'all have an awesome day.